first understand the concept. We need to first understand the concept of economics. You can't just say what is money and then without knowing the concept of what economics. Now, economics is a social science that study how individual, businesses, government, society make choices about how to allocate what scarce resources to satisfy what unlimited wants. Now, the core question is, what is the core problem that these economists tend to identify? We have scarcity. We have limited time, money, and resources. But our desire are what are endless. That is why economic is the study of how we manage this gap. Let's take a look at a practical example. Looking at, for instance, now you have a 10,000 naira, and also during weekend people want to flex and delight there, and you have maybe free Friday night. You can either buy yourself a new video game or go to a concert with friends. At the same time, you can also choose to save the money for the next month, maybe as regard to your tutorial, to your textbook. Now, but you cannot do everything at a go. So that is what economists tend towards. So economists study how you make that choice and what you give up for the opportunity what cost. It shows that you either decide whether you want to go for the nightclub or you want to reserve the money for your maybe for textbook, for other things. So that is what economists tend to address. Now, another thing you need to understand is that when we're talking about this economics here, we have two main branches of economics. Now, economics is divided into two main lenses. And what are they? We have what we call microeconomics. We also have what we call macroeconomics. Now, when you're talking about microeconomics, we're talking about a small picture. And when you're talking about macroeconomics, we're talking about what? Big picture. I'm going to explain more on that so that you begin to understand the difference between both of them. That is why that when you first started economics, they first introduce you to what to major things or major concept in what economics, which happen to be what macro, by micro. Rather, we also have what we call what macro that look at the bigger aspects of what we intend to look at in what in economics. So that's why we say that there are two main branches of what economics. Number one is micro. Number two is what? Macroeconomics. Now, I said that micro has to look at a small picture, while macro is looking at what? The big picture. Now, when you talk about a small picture, microeconomics is looking at the study of individual economy. Now, it's also look at the behavior of specific what? Household, individuals, workers, single firm, specific what? Market. Now, when you look at under macro, what is the focus on micro what? Economics. Now, if you look at supply and demand in a single market, pricing of specific goods, now individual consumer choices and a firm what? Production cost. Now, let's take a look at a practical example. Now, imagine the market for a smartphone. And if a new technology make microchips cheaper to produce smartphone, company can lower their prices. Now, microeconomic studies will look at how the price drop affect your what decision to buy what iPhone versus what Android phone, and how it affect what Apple what or iPhone what profit. Now, if you look at that scenario there now micro does not look at, it only look at a small picture. Looking at what it's looking at how price drop affect what your decision to buy what iPhone and between what Android phone. If you imagine now, if you look at some people now, they can't do without iPhone. Even some people can die all because of what iPhone. But if you look at what microeconomics tend to look at, it look at how your decision to obtain iPhone rather than buying an Android phone affect. Not only that, it also look at how the profit also drop due to the decision that is being made by what by the people. But in terms of macroeconomy, which is the big picture, that one study economy as a whole. It study every aspect. It does not look at how just the profits of a iPhone versus a Android phone drop. No, it look at the study of a whole what of economy as a whole. That is the nation, the entire globe. You look at the aggregate and you talk about the national economic goal, that is GDP. That is the overall. You look at overall unemployment rate, economy-wide what inflation, government fiscal and monetary what policy. Now, instead of looking at the price, I'm just trying to differentiate between microeconomics and macroeconomics so that you can have a clear understanding of what this portray, what this look like. Now, instead of us just looking at the price of one smartphone, now listen, macroeconomic look at national inflation rate. Now, if the prices of everything like food, rent, gas, phones rise by 5% across the entire country, let's say this year. Now, microeconomics will study what is happening and what the government of central bank should do to what? To fix it. It will not just look at the profit side. It will not just look at why people just make what decision. It make a look at okay, for instance, now look at the cost of fuel now. Before they remove fuel subsidy, we are buying fuel at the rate of 200, 400, 600. But look at the cost of fueling today. The cost of fueling today is not the same like before. Now, it shows that by the time you want to even buy fuel, you have to spend triple of the amount you used to purchase at before to obtain the same what quantity. So, what do we say? We are saying that macroeconomics will now look how does this inflation rate affect everything in what in general. You can see as the cost of living is rising, what happened to the cost of accommodation? What happened to the cost of everything around you? Everything is what is skyrocketing. So it shows that it's affecting a lot of things. So that is also why we also take a look how does the government or central bank, what did they do to fix what this what issue so that it does not what escalate. So that is the difference. That is what macroeconomics is talking about. So that is what differentiates between the small picture and the big picture. I hope you understand. Now, that is why if you look at our slide now, if you look at our slide, you will see that we have what we call introduction to money. Now, I don't just want us to divert to just talking about money without taking a proper look at what economics as a concept look like and what like now when you talk about money now, money fall under macroeconomics. That is why that if you look at it here, the macroeconomy view money or just take money for granted. But when you look at macroeconomic view, it study money because total amount of money in an economy dictate the health of the entire nation. Microeconomics study what we call money supply. It study also what we call inflation. It study what we call monetary what policy. That is why that you see something like a federal government, federal reserve you even see it in different countries, in US, just like a consulate, and how they manipulate what interest rates and the money supply to control what inflation or fight what recession. So that is why that we have to just take a practical glance at what the difference between the branches of economics, which is micro and macro. I believe that by now you should have a proper what understanding of uh, differences between micro and macro economics. Now, today we are going to start a topic under one of the aspects of the macroeconomic, which is what introduction to what money. Now, if you look at my slide now, you will see that there's an overview of what we are going to be looking at. I said that this section introduces you as a student to the concept of money and working a financial system. In this section, we are going to be explaining the meaning and the function of money and also give an overview of financial system and introduce the principle of fractional reserve banking. And also, this section will also cover measurement of money supply and equilibrium in the money market. Now, what is the objective? This class objective is that at the end of the section, students should be able to do the following. You should be able to define money and explain its main function. You should be able to explain the structure of financial system and the role of financial institution and financial market. Not only that, you should also be able to explain the concept of demand for money and main determinants. As also, you should be able to identify the measure aggregate money supply and demonstrate what we call equilibrium in the money market, where interest rates are what are determined. Now, we're talking about money. Now, if we are talking about money, I just want you to understand that we don't just arrive at money in a day. Before money existed, people use what we call barter system. That is why we're talking about barter and evolution of money. Now, before the discovery of money, well, if you look at it, the alternative to money system, now the economics, they rely on what we call what barter system. And what is barter system? That is exchanging of goods and services. But if you look at what we're saying here, a barter system is characterized by what direct exchange of what goods and what services, meaning that we are exchanging one commodity for what for the other. But at that point, when we are doing trade by barter, before the advent of money, now there is a problem that associated with what with barter system, and which make barter to be what inefficient was the what need for what double what coincidence of wants. Now, let me give you a proper explanation concerning that. For instance, now before, don't forget that we said that it has to do with direct exchange of goods and services. Now, before the advent of money, I told you what we are doing is trade by what? Barter. Now, for instance, you look at someone, or let me say, someone that is looking for yam. Another person may be also be looking for shoe. Now you can see that there is a double coincidence there. Now, the person that is looking for shoe is different from the person that is looking for what? For yam. Now, look at it now, before a person, look at in our slide now, before a person A can trade with person B, that is the person looking for yam and the person looking for shoe. Now, person A must want what person B has, and B also must have what the person B is what is looking for. Now, because of this double coincidence, that's what led to the what evolution of money. There was a problem at then, because if you have something you can use to trade, but if the other party does not want it, it shows that transaction between both parties will not be able to happen. So it caused a really what a lot of problem. Now, imagine a farmer with wheat and they need shoe. Now, if that farmer, I get him now, look at it now. You must find, so we sure that for you to be able to exchange, you must look for a shoemaker who uh, only has a what shoe, but also want what wheat. Now, but if the shoemaker wants meat instead, you can't trade. That's what it implies. So this inefficiency led to what evolution of money as what exchange of medium of what exchange. Now, I believe you are still following me. So, another thing we're looking at so that you can have a proper understanding before we move to the main thing in this aspect of money is that's whether we're just looking at what the evolution so that you have a proper knowledge about this topic. Now, the question now is what is money? You have seen what led to the advent or to the evolution of money due to what double what coincidence. Now, what is now money itself? Now, money is anything commonly acceptable as a medium of what exchange. Now, throughout history, a number of different commodities have been used as what money. Now, before even money come into place, we have gold, we have oil, we have copper, we have a lot of commodity that people also use as a medium of what exchange. But if you look at this now, this also does not provide a proper what solution to the issue of what barter system. Because looking at gold, sometimes, okay, what about if gold is scarce? What happened to the what? To medium of what? Exchange. When we are using what? Commodity like gold, like oil, and what? And copper. So if you look at it now, we use it for thousands of years. We also have what we call cowrie share. That was used in Africa and what? Asia. So we are now looking at it. Look at what we are using back then. But this could not what provide what appropriate solution to the issue of what double coincidence. Now, if that's why we're now looking at paper versus commodity money. Now, paper versus commodity what? Money. Now, the main disadvantage of commodity money, if you look at our previous listen, I talk about gold, I talk about copper and the like there. These are commodity. The people also use commodity as a means of what? Exchange, but could not survive for a long period of time. Now, looking at commodity here, commodity, you look at it, paper versus what? Commodity. Now, the main disadvantage of what? Commodity money is the disadvantage is that the item used as money add what we call intrinsic what? Value. Now, let me throw more light to that so that you can have a proper understanding of what I'm talking about. Now, look at gold, look at silver, and other what? Other things. Based on what I told you earlier on, for that gold, for that silver, they can be scarce tomorrow. What if they are scarce? What will people use as a what? As a means or for exchange of what? Of money. So that's why we say that it has what we call intrinsic what? Value. Now, another thing is that they could be in high demand for a what? For a reason. Now, if the number of people that are demanding or looking for gold is much, what will happen to people that could not meet with what the high demand? So there could be an high demand for reason other than their what money what function. Another thing we see here is that they were limited in supply. Now, because of this limitation now leads to what led us to the use of what paper money. Now, and the current paper money we have is what we have the is fiat what money. Fiat money was the one that is being declared by the what? By the government, which serve as a what? Generally means of what? Acceptable means of what? Exchange. Now, if you also look at advantage of this fiat money that was being declared by the government, if you look at it, the advantages of it is one, it's easy to carry. You can hold money, even though when you hold money in your pocket, nobody can even know you are with thousands of naira. So it's easy to what to carry. Another thing is unlimited supply. Government what control. Now, another thing, let's just take a look at a practical view of what we are saying since. Now, you can't eat or build with it, but everyone accepts it for goods and what? And services. Now, meaning that even sometimes, if just like now you ask someone, what is your net worth? Mere standing or looking at the person's bank account, you may not be able to declare the person's potential or net worth. But what the person possesses, his value and everything, he can also use it as a means of what, or for a means of what, exchange and later on, just like someone that has a property. The person may not have much in his bank account, but due to this property that he has, we can use it as a what, as a means of what, collateral, or as a means of what, exchange in the what, in the future. So that's why we said that the paper of fiat money is easy to what, to carry. It has unlimited what supply and also a lot of what function. So we are going to also be looking at the functions of money. Function of what? Money. Now, money performs three main functions, which I want you to understand very well. Number one is what? Medium of exchange. Remember, anything that is not generally acceptable is not regarded as what? A means of what? Is not regarded as money. So money is a what? Anything that is generally what? Acceptable. and you can use it for medium of what? Exchange. But when you look at this function of money here, we said number one is that money as a medium of what? Exchange. Now, meaning that this money we're talking about as a medium of exchange facilitates buying and what? And selling. It implies that you can sell for what? For you can sell your what? Labor for what? For money. That's why that you see even some government official or you see someone who is working as a salary earner. You see the person that the person is working, is selling his labor in exchange for money at the end of the what? Of the month. And if you sell your labor for money, then you can use the money to buy food, clothes, and other things that are what? Essential to you. So that is why we say that money serves as a medium of what? Exchange. Another thing we also see about function of money is that money serves as what? Unit of what? Account. Unit of account. From our slide, you said that money allows us to value all things and compare how valuable things are. Let's take a look at what we are seeing here. We said that money measure and compare what? Value. Now let's assume, look at it now. I have a laptop, and that laptop cost about 300,000 naira. And I have a phone that costs, let's say, about 100,000 naira. Now, because look at it now, because you need to look at it now, it makes us to understand the net worth of the phone and also of the what? Laptop. Now, the laptop is worth three of your what? Of that phone. Because laptop costs 300,000 and phone costs what? 100 what? Thousand. So we can be able to compare and contrast and say, oh, definitely my three of my phone can buy this what? Laptop. Now, another thing we are able to see or deduce from here is what we call store of value. Now, store of what? Value. From our slides here, we can see that we can easily convert perishable items into money and store them for what? For future. Now, what are we saying in essence here? We are saying that money can be saved for future what? For future use. Now, let's assume, look at it, take a look at it. You are earning 300,000 naira in a month. Or let's just say you are earning 3,000 in a month, and you decide to spend 2,500 out of the 3,000 you are earning in a month. It will also cover some utilities, some other things like that. But out of that 3,000, if you are spending 2,500, you know that you have a balance of what? 500. So which implies that you can save the 500 that is remaining for the next what? Month. Now, the problem now is inflation reduces what we call purchasing power over time. Now, imagine what you bought today at the rate of 50 naira. Tomorrow, you may go there back, and then they will tell you that what you bought at 50 naira yesterday is now 200 naira. So it shows that inflation reduces what we call what? Purchasing power over what? Over time. So that is why that when there is a store of value, that is just the problem that associates with it. That it reduces purchasing power over what? Over time. Just like the cost of accommodation now, it's not like a 3 or 4 years ago compared to what we are seeing now. So it shows that inflation has reduced what? The ability to be able to collect what they want or suit for them what? For them safe. So that is what we mean by that. So the what we call standard of deferred payment. Standard of deferred payment. Now, when you talk about standard of deferred payment, what are we saying about money enable borrowing and lending? Though it may not be more, how will I put, more efficient here in Nigeria, but if you look at it even nationwide, they are making use of it. You see some of your colleagues that even travel out. At the end, you are seeing them, they're already using what? A car already. Not because they purchased it, but because the country allowed them to be able to make use of what standard of deferred what payment, which what that is The money also serve as a medium or enable us to borrow and lend what? And lend. So it enable borrowing and what? And lending. Imagine you take 20 million car loan and you said that you're going to repay over what? In 5 years. So that's what we're talking about of what? Standard of deferred payment. So we move to what we call monetary aggregate. Monetary what? Again, we just want to look at everything that is associated with what? With money before we move directly. Because if you don't understand the basic concept of what? Of money, you're not able to understand what economics is really talking about. Now, if you look at monetary aggregate here, we say monetary aggregate refers to how aggregate supply of money is what? Is measured. And money aggregate can be classified into two main groups. You have to understand that. Now, in economics, you will see we have what we call narrow money, which is also referred to as what? M1. That is called the most liquid. Most liquid. I'm going to explain. Now, we also have what we call broad money. Broad money, or what we call what? M2. So, you may be saying M1, M2, but if you come across your macroeconomics there, by the time we get to calculation aspect, you'll be seeing this terminology. But if you don't understand it now, you may not be able to understand how we arrive and why we are making use of this word terminology. So when you see M1, it's talking about narrow money, and when you see what M2 is talking about what? Broad money. And broad money comprises of what we have in M1 and other what? Additional factor that is enabled therein. So if you look at the M1 here, the M1 is talking about currency and coin in public hand. We also talk about demand or deposit, that is checking account. We also have what we call, which is not there, but we also have what we call traveler word check. Now let me just give you an example. For instance, now you have what we call, or let me, we make use of BLT daily, and then there's what we call wallet and also your card word transaction. Now let's assume that you have 500 naira in the wallet of your BLT card, and you also have 1/8 in your normal BLT card. In total, it's called what? That is 2,000 naira. That is in what? In M1. So it consists of what we call what? Your money in your wallet and also of your checking what? Account. That is your demand deposit to equate to what? The total, which we refer to as what? M1. Now, in M2, which is referred to as broad money, the broad money minus what? That is M1 plus less liquid asset. Now, this includes everything in M1. Your saving account, your small time deposit, and your money market what? Accounts. Now, these are the what? The two under two things to have under what? Money what? Aggregate. But what is the key difference between M1 and M2? If you go to a bank, you will see that people that put their money on fixed deposit. Fixed deposit simply means that you will not be able to touch the money for certain numbers of what? Numbers of days. Now, but in the case of them, I'm just trying to use a small terminology to be able to explain so that you'll be able to understand very well. Now, for that M1 is just like your saving account. I get it now. In M1, you can spend immediately. But in a situation where you have your M1 plus money that is saved, that can be accessed relatively quick. That is what the difference between what? That is the key difference between M1 and M2. When you put something in a fixed deposit, you can still access it, but not immediately as you have it in what? M1. Now, because of our time, let's quickly move to another one, which is called demand for what? Money. Demand for money. If we don't understand all this terminology or all what we are saying, You not be able to have a what a clear picture of what all these things comprises about. And that's why I have to first lead you through the concept of what economics as a whole, and talking about the differences between what macro and what and micro and macro what economics. So you can be able to know that economics is very, very broad. So, but most especially you as a someone doing an A level or pursuit hear me, what the examination body will be mostly more concerned about is macro what economics. They want to know whether you have a clear picture or you have a broad understanding of what all these concepts we're talking about really is in a real life what in a real life setting. So that is why that we want to take a look at what we call demand for what for money. Now, when you talk about demand for money is the demand for what real money what balances. Now, look at it here. This is the demand for the most liquid form of what money than other what interest bearing what asset. Now, the demand for money refer to the quantity of money an individual want to hold for transaction or other what purpose. It shows that people hold money for reason. They didn't just hold money uh, just to do anyhow thing, but they hold money for particular what reason. And we can see here that there are two what sources of demand for what for money, which is transaction for money and assets for what for money. Now, when you look at for the under the transaction demand for money, money held for what? Money, we hold money for everyday purchases of goods and services, but you have to understand what are the key determinants for holding this what? Money. Now, number one, you have what we call price level. We also have what we call income level. Now, if price double, you will need twice as much money for same for what? Purchase. Now, based on what I told you earlier on, if the purchase of maybe a smartphone last year cost you 50,000 and this year is 100,000 now, it shows that you are spending what twice of the money you are holding. So you also need to hold money for what transaction. Now, because of our time, also we also look at income what level. We are talking about there's what we call the higher the income, the higher the transaction what demand. Now, example for instance, now a student looking at a student and a professional earning, their gap is what is different from what one another. Now let's take a look at asset demand for money here. Now, money held as a store of value, save asset investment. Now look at it now. People divide what wealth between liquid safe assets and liquid what risky what asset. That is what when we talk about stock, bond, real estate, and the like there. So it shows why people demand for what money. Now, why do we now hold money as an asset? We hold money as an asset for safety. Money is the safest what asset. We also have liquidity immediately available for what emergency. It's not something you plan for, but when it's occur, because of what you have that money, you can use to attend to anyone, anything that you want. That's we also hold money for what uncertainty. When the economy is unstable, people prefer to what hold cash. Imagine when we have the kingdom of cash scarcity. People decided to hold money for other what purposes. Now because of our time, there's not much time again. I will have thrown some more, will have attend multiple questions, but I will try to just drop some of it. And I want to answer it practically. Some may be in form of a case study to show whether you really understand before we move to what we call financial what system in the banking what sector. Because more